Hello, everyone, and welcome to this special recording of the weekly market recap for the week ending Friday, August 16th. I'm Tom Bowley, Chief Market Strategist here with earningsbeats.com. It's a pleasure to be with you. We are doing this recording a little early. I'm going to be traveling this weekend, so we're doing this as a Thursday evening. So as you look at prices maybe on Friday or during the weekend, just realize that I'm doing this Thursday evening as opposed to after the market closes on Friday. Still, it's been a very, very busy week. We've had a couple of key inflation reports already out. On Tuesday, we had the July PPI report come in. Both of those came in better than expected, both the core and the headline number. I think the headline number was expected to come in at 0.2%, and instead rose, I believe it was 0.1%. And then the core PPI, which was expected to come in at 0.2%, was flat. So we got really good news on the inflation front on Tuesday, but that was at the producer level. I think the market and the Fed probably paying a little bit more attention to what is going on at the consumer level. And that report came out on Wednesday, July CPI out Wednesday morning, and that came in as expected. Both the headline number and the core number were expected to come in at 0.2%, 0.2% rise, and they both did. So not great news, but not bad news. So in this market, during this rebound, I think right now, just anything other than bad news is good news. And so that was, I think, viewed still pretty positively. On Thursday morning, we had initial jobless claims. We had a lot of reports out, but two that I was watching really closely. Initial jobless claims, that tends to lead to higher unemployment number if those initial jobless claims are rising. But for the second straight week, we've gotten relief. We've actually seen initial jobless claims come in below expectations. And then also we had retail sales come in above expectations. So the economy seems resilient, which is good because the Fed now probably has the luxury of waiting. A couple of weeks ago, the market took the big downturn because we started seeing signs of economic weakness. And if economic weakness starts and the Fed does nothing about it, then obviously that could escalate and grow much deeper. That doesn't appear to be the case, and I think that's been the reason for the big rally this week. So I don't know if the Fed's going to cut in September or not. I think as long as we get good economic reports, I think that gives the Fed a little bit more time to consider what they want to do with that policy. If we start to see economic conditions worsen again, I think you're going to see the market move back to the downside, and that could put a little bit more pressure on the Fed to maybe think about backing off of the keeping rates higher for longer mantra and maybe moving into a rate cutting mode. But right now, I think the Fed is getting exactly what it wants. It's getting the inflation numbers coming in at or below expectations, and also still seeing the resiliency of the U.S. economy. So good on both fronts, and I think that's why we're seeing the reaction that we have in the market, where we've come literally right back up almost to where we were a couple of weeks ago when I issued that big warning. And I said, hey, we got economic issues beginning to build and the Fed not really addressing them. That created a big tumble after we talked about that. Well, we've gotten it all back because things have flipped. And the Fed's getting good news on inflation, but also getting good news on the economy as well. First chart today, I want to go over, this is one I always like to start with. This just shows you over the last week how all of our major indices and the 11 sectors are doing relative to one another. So as you look at this, technology, NASDAQ 100, consumer discretionary, S&P 500. These are really four great areas that we want to see on top. This is where most of the aggressiveness lies. Technology, consumer discretionary, the NASDAQ over the S&P 500, and then everything else, kind of fends for itself. But the one thing that I really like is the fact that everything's up. So we've got this wide participation in this move to the upside. Obviously, not everything can outperform the S&P 500, but the two key sectors that are outperforming are the ones we want to see outperform. So this is one of the reasons why I believe that the August 5th low is going to turn out to be our low of 2024. I mean, obviously, there's always a chance things start to pick back up in terms of economic weakness. Maybe next month we get the inflation numbers start to shoot back up again, or maybe with the PCE. We're not completely out of the woods, but this is one signal that's telling me that maybe we're just looking at perhaps sideways consolidating over the next month or 2 months, as opposed to seeing a big sell-off. Moving on to the S&P 500 chart. So another really good day, and it wasn't but maybe a week ago, I laid out probably 5 different levels to watch as resistance on the S&P 500. We have gone up and taken out every single one of them this week. All of them. Not even with hesitation. Just boom, boom, gap ups and follow through, gap ups and follow through. Really, really good market action. We cannot ignore price action. I don't care about all my other secondary indicators, sustainability ratios. They don't look great, by the way. I'm going to show you those in just a minute. But number one in the hierarchy of everything I look at is price action. Nothing is more important than price action. Now, sometimes you have so many secondary indicators that line up against the market that it's just a matter of time, and you just have to see the price action confirm on a move to the downside. That really isn't the case right now. We have a few issues. I have a few issues with the market, with my secondary indicators, but not all of them. And the price action here has been absolutely beautiful. Great move up the last 8-9 trading days. You couldn't have asked for a better recovery, to be honest. I didn't expect it, but I'm not going to argue with it. Really big move back to the upside. Today finishing maybe back at a neckline. This could be a neckline. Really zero in here. Maybe with the top, the close on Thursday. Maybe that kind of coinciding with the top that we saw at the end of July, right before the Fed announcement. And so we have a neckline. We already have a left shoulder over here. So we have the top, left shoulder, neckline, head, right side of the neckline. And then potentially, if we were to pull back, maybe print a right shoulder, inverse right shoulder. So that could be, or maybe we just go up and we test the prior high. I mean, this could be a situation where we go up, back up to the high that we saw in July. I would have never thought it 2 weeks ago, but hey, it's happening. Can't deny it. Maybe we go all the way back up there and then we pull back and move sideways for a while. But the fact that we've climbed back above the moving averages really makes me more bullish, because during downtrends, normally you don't see this kind of behavior where you go back up through multiple gap resistance levels, multiple price resistance levels, and both key moving averages. And we did it with gusto today, gapping up above it and trading up all day long. Another trend day. And we've seen a few of these recently. So again, can't really argue with the price action. To me, it's telling me that we're not going to go back down below that August low. We'll see. Also, down here on the bottom, I wanted to mention the VIX. Last 2 days, we've closed below 17. Go back as far as you want to, at least as long as the VIX was out. But if you go back through all the prior bear markets, during the bear market, we never saw the VIX go back down on a rally. We never saw the VIX go back down below 17 and then go back on the S&P to a new low within that same downtrend. It's not happened. And part of the reason for that is that one of the common denominators with a bear market, all bear markets, is fear. You have to have that elevated fear. That's what triggers the panicked compulsive selling or impulsive selling. And I think with the VIX back down in the 15s, lower 15s, closing at 1523, I think that's a sign telling us that the fear is no longer there. And it would have to do something that if this turns into be a bear market, the VIX will be doing something right now that we have not seen in any prior bear market, where we go back down and see the VIX below 17 for 2 consecutive days, especially all the way down to 15. So I think that argues for sideways consolidation and ultimately breaking out back to the upside. Another look, these are my sustainability ratios. So this is what I was talking about. I've communicated this with members. But if you look from the high to the low and you apply the Fibonacci retracement tool, you're going to see over here that the S&P 500 now has gone back and cleared every one of the three key levels, Fibonacci retracement levels, the 38.2%, 50%, and 61.8%. All three of those levels, all the gap resistance, price resistance, and the moving averages have all been left in the dust in 9 trading days. Pretty amazing, honestly, this recovery. But here is one of the secondary indicators that tells me, all right, we're probably not just going to go up and set all-time highs. And so this is what I'm looking at. Here is the ratio of the QQQ to the SPY. So the NASDAQ 100 to the S&P 500. NASDAQ 100 is more aggressive. Normally, that would indicate that when prices are going up, we want to see the NASDAQ do better because it tells us that there's a risk-on environment, which is when most secular bull market advances occur. We want to have that risk on. Look at the same Fibonacci tool on this ratio of the QQQ to the spider. Massive decline in terms of risk assets being sold off. And now during this 9-day recovery, all the way back up, getting close to all-time highs, and the S&P, we just talked about it, S&P has gone back through all the Fibonacci levels. This risk ratio that I like to follow hasn't even gotten back to the first one yet. So it is not like the risk assets are screaming to the upside. Now, they are, over the last couple of days, we've been seeing more growth-oriented stocks performing better. But prior to that, it was not the growth that was leading this move to the upside. So we still got a lot of work to do in growth. And I would be more concerned if we start to see this growth ratio or this QQQ spider ratio roll back over. But for now, it is moving in the right direction, but we've still got a lot of work to do to get back to where we are on the S&P 500. How about the XLY, XLP? We went in the middle part of July from a high all the way down to a 52-week low on this ratio, discretionary versus staples. This is probably the ratio that mirrors the S&P 500 the closest over the long term of all the sustainability ratios I follow. And it makes sense. GDP is made up of 2/3 of consumer spending. 2/3 of GDP is consumer spending. So if the money is being spent, if we're seeing the consumer discretionary stocks outperforming, it's telling us, it's just giving us that sense of more risk appetite out there. You know, that folks are looking to spend money on things that they want as opposed to things that they need. And so, but again, we're not even back to that 38.2% retracement. So the risk ratio isn't bouncing nearly as much as the S&P 500. That might be a problem. And from a secondary perspective, as far as I'm concerned, that's not bullish. I'm not saying it's bearish, but it certainly isn't bullish. And then finally, the IWF, IWD. This is growth, large cap growth versus large cap value. There was the sell-off from the top back in July. And here was the recent low. And here's our recovery now during this 9-day period. At first, when we first started bouncing, here on the S&P 500, we gapped down on August 5th, and we've been rallying ever since. So on this line right here, and you come down and you see this is where the rally started. And look what happened initially. We saw the XLY, XLP going down. We saw the IWF, IWD going down at the beginning. So even though the S&P was starting to recover, it was not really showing up in terms of our risk ratios, sustainability ratios. So we now are starting to move back up. That's a good thing. That's what we want to see continue. But we are way behind, again, the S&P 500. All right, seasonality. I just wanted to point out, I've broken down this. This is an S&P 500 chart. It's also, these numbers relate to the S&P 500 going back to 1950. So this is 75 years worth of data and how the S&P 500 has performed in each of the 4 quarters, with each quarter broken down by the first half of its quarter and the second half of its quarter. So for instance, Q1, January 15th to February 15th is the first half. February 16th to March 31st is the second half. That fully encompasses the entire Q1. Look at the first half versus the second half. Much, much stronger. 12.5% to roughly 4 2/3%. Almost 8 percentage points difference. More bullish in the first half versus the second half. How about Q2? First half, the annualized performance or annualized return since 1950 of the 45 days that make up the first half of Q2, 13.15%. Second half, so now we're talking about May 16th to June 30th. Second half, 1.96%. More than 11 percentage points difference between performance in the first half of Q2 and performance in the second half of Q2. Now we're in Q3. Today is the end of the first half of Q3. First half of Q3 averages going up 9.85% since 1950. That's been the annualized return. The second half, which we're starting tomorrow, Friday, it's the only half of any quarter that's negative. The annualized return, minus 5.18%. The difference between the first half and the second half is about 15 percentage points. The widest margin of any quarter. It's like the first half of Q3 is okay, second half, not so much. And this is also when in presidential election years that we tend to see weakness as well. So if I'm not jumping up and down in my seat right now bullishly off of these last 9 days, you're seeing some of the reasons why. I think that this is great for the long term. I believe, and I've said this even before I warned about the market going down, that to me, we're still in a secular bull market. This is not, if we've moved down, even if it was a bear market, it was not going to be a secular bear market. It was going to be a very quick cyclical. At this point with this rebound, I don't even think we're going to see any, I don't think we're seeing any bear market. I don't even believe we're going to go back down below the August low. But we still have issues. And that's my point, really. And that should be the theme of this presentation. It's not that I think the market, needs to just go screaming lower. I do think we could rally all the way back to the July high. I would be very surprised if we break out, just because of all these different historical, numbers that we're looking at, and then also looking at the risk ratios, those sustainability ratios I just showed you. So it's just keeping me grounded as the market continues to move up. So essentially, we've gone back up now above where I warned that the market was going to head lower. We did move down over just a couple of days very quickly, but in 9 days since, we've come back and we've gotten all that back and then some. So it's been an impressive rally, but how much weight do we put on this second half of Q3? How much weight do we put on the presidential election cycle, where September and October tend to be very, very poor months in those election years? How much weight do we put on the fact that, the growth isn't really coming back the way it went down? Went down very rapidly. It's coming back, but it's coming back much slower. What should we take from that? How about the fact that growth versus value, best 4 months of the year, without a doubt, May, June, July, and August. And here we are, it's August 15th at the close. We only have 15 more days of this really bullish historical period for growth stocks. So you just put all this together and it's just like, I kind of feeling like we're going to have chop. Initially, maybe this, like I said, the rally, maybe we go back up and we test the all-time high. But I believe that we're going to see some choppiness throughout the balance of the third quarter. Some, rallies, some selling, and it just depends on, if you're okay with that. Again, from a longer term perspective, I would be okay with that. I think the market goes higher. I don't think there's a need to try to time a short-term correction, or even if it had been a cyclical bear market. Long-term investors, I would probably tend to hold on to my, holdings, my ETFs or whatever through whatever we have to face here in the balance of Q3. All right, I'm going to give you 5 stocks from 5 different chart lists. Because we do a lot of research at Earnings Beats, and we keep various chart lists for our members. So the first one I wanted to show you was Trade Desk, and Trade Desk comes to us from our raised guidance chart list. So this is a stock that recently raised guidance. And if you look at the stock, it's had a couple of really strong candles. Maribozu candle about a week ago. That would have been last Friday, I guess, where it opened at 90, closed at about 99 and change, and it just went up all day long. Very much a trend day. 102.5 is roughly the all-time high on Trade Desk. So we're getting really close. We closed over 100 today. And if you look down, software still has not been performing well. Trade Desk is a leading stock in software. So if we could just get a little bit of strength going in software on a relative basis, I believe Trade Desk could make this breakout. So it's a stock I like. I think it's had a pretty good long-term track record, and it certainly seems poised to want to make another breakout. IOVA, this is off of our short squeeze chart list. So every couple of weeks, we update our short squeeze chart list to provide our members with the stocks with the highest percentage of our highest short float. It's getting late. I'm trying to think of the wording. Short percentage of float. There we go. So any stocks that have a short percentage of float that are more than 20% are on our chart list. Right now, IOVA has about 26%, a little bit over 26% of its float is short. If you're wondering what float is, float's the number of shares that are available to be traded. So 26% of them are borrowed against for short sellers to then short. So you got a lot of sellers out there that at some point are going to have to buy. Now, I mentioned recently the biotech group is getting close. The Dow Jones US Biotech Index, which is the $DJUSBT. $DJUSBT. The biotech index, if that breaks out above 3,100, I think we could see a lot of money rotate into biotechs. And IOVA is one of 20 biotech stocks that are on the short squeeze chart list. 20 of our 68 charts are in biotechs. Now, I like this one because it has made this breakout. I believe it was with earnings. I think earnings came out late last Thursday evening, I believe. They beat top line, they beat bottom line, they gapped up, and they closed at the highest level in about 2.5 to 3 months. So that means that anybody that shorted this stock over the last 2 or 3 months is underwater. And so when you get into these types of situations, now one thing I'm watching volume, because with a short squeeze, I don't think a true short squeeze is really underway yet on this stock. With a true short squeeze, we should see volume just absolutely soar, kind of like we saw back in mid-February when volume just shot up for 3 days and the stock ran from $9 up to maybe somewhere around 16, 17. That was almost 100% move in 3 days. That's what a short squeeze looks like. So this is a stock that I'm certainly keeping an eye on. We've mentioned it in our Earnings Beats Digest newsletter, which you should go over to Earnings Beats and earningsbeats.com and sign up for that if you haven't already. It's a free newsletter. But that was featured Wednesday morning. And biotechs as a group were featured on Monday morning. Those are the 2 days we send out articles to our EB Digest subscribers. So anyhow, I think IOVA looks interesting for now, and I'll definitely keep an eye on that volume, because if the volume picks up and this stock really starts to make a move to the upside, to me, it would be a signal of a short squeeze. DCTH. So this is off of our strong future earnings chart list. So we have a strong earnings chart list, but then what if a company is trading great, but didn't beat top and bottom line in their last quarter? They're not going to be on the strong earnings chart list, but they're still a stock that looks pretty good technically. So that's why we created the strong future earnings chart list. I don't know if it means that future earnings are going to be great, but the stock is performing pretty well on a relative basis based on its scooter score, its stock charts, and it's not on our strong earnings chart list. So these are companies that still show great technicals, but they didn't necessarily meet the fundamental requirements to be on the strong earnings chart list. Anyway, DCTH, I really like this one. I'm going to annotate it for you. This is a stock that has pulled back right to prior support right here. And then if you come over here, we just had a hammer. We went below that support level intraday, came back up above. And then today we actually showed a higher high and a higher low. So this could be the start of a move back up to that double top around $9. We're sitting at $7.49 right now. If we get back up to $9, that'll be a 20% move from the current price. So, and you've got fairly tight stop if it breaks down. You can get out, anything below 735, 740 probably would be an issue, at least, to consider in the short term. But I do think this has a decent shot at returning back to $9. All right, two more to go. One off of our strong earnings chart list. And this is Trupanion. There's a lot of hollow candles in here. The volume's been picking up here in August on this move to the upside. AD line is just shooting to the upside. And when I look at relative strength, it's performing well relative to its property and casualty peers. And property and casual is performing really well relative to the S&P 500. They're both going up right now. So I like this as a stock that is likely to outperform going forward. I would prefer to get it on a pullback closer to that rising 20-day moving average. So for now, I would just keep it on a watch list like we do with the strong earnings chart list. But this is one that certainly appears to me to be somewhat appealing to watch here over the next several days and maybe even a couple weeks. The last one is the bullish trifecta chart list. I'm going to show you a stock from that. This is APP, APP. It's AppLovin Corp. Another one kind of like Trade Desk that is up trying to set new all-time highs. We got some tops coming in at about 87.5 up to maybe about 92. And we closed on Thursday at 85.58. So we're getting really close to that level again. On this push to the upside, you can see the volume has picked up. I think the volume trends here look good. AD line right back to the 52-week high. So I think that looks good. And then when you look at the relative strength versus software, all of a sudden here in August, we are starting to see another big pop in terms of relative strength in a group that really isn't doing that well just yet. So if money rotates or starts to rotate more back towards software, that would really, likely send APP and TTD up through those prior highs and set new all-time highs on those two stocks. So I like both of them based on their leadership. Now, if you wonder what the bullish trifecta chart list is, it's actually the combination of, in order for a stock to get on our bullish trifecta chart list, it has to be on our strong earnings chart list. It has to be on our raised guidance chart list. And then it also has to be on a chart list I haven't featured here, our strong AD chart list. And that's just a chart list of companies that are showing very strong AD lines. And so anyway, app is on all three of those chart lists, which makes it a qualifier on this bullish trifecta chart list. I can tell you right now, our bullish trifecta chart list only has 49 stocks on it. Only 49 stocks meet that criteria of being on our strong earnings chart list, raised guidance chart list, and strong AD chart list. So it's looking at stocks from different angles. Strong earnings means we just beat the prior revenue and earnings estimates. Raised guidance means management's looking forward and they have raised guidance on the stock based on either revenues or earnings or both. And then strong AD is telling us that it at least appears that the stock is under accumulation. So being on all three of those chart lists is kind of a big deal. And APP is one of those 49 stocks. And take out a trial subscription at Earnings Beats. It's free for 30 days, and you can check out all of our chart lists. Make sure you check out the short squeeze chart list. I think that a lot of traders really like that one. And then, of course, the bullish trifecta chart list is 49 of the best stocks out there. All right, I think that is it. So I'm going to go ahead and recap this thing and conclude. Like I said, markets recovered nicely. I really thought that we were going to be in for a lot more trouble than what we've had. Nice recovery these last 9 days. And price action is number one in my mind. It sits up there all alone by itself. Anything else I talk about is a secondary indicator that's way down the totem pole. Um, I love what's happened with the price action. I'm not going to lie. So I think that means the move back up through key moving averages means that we're probably in a sideways consolidation pattern now, as opposed to a downtrending pattern. That's the big takeaway that I've taken from the last 2 weeks of trading and the way we've rallied back. So anyway, again, I'll be gone for the weekend. Got a golf tournament this weekend. So I at least wanted to get you all something here on Thursday night for the weekend to give you a little bit of a recap of what we've been seeing and what we may see as we look at the week ahead. Anyway, everyone have a great weekend. Appreciate you tuning in. Be sure to go over to Earnings Beats. Sign up for that EB Digest if you haven't already. That's our free newsletter, no credit card required. Or if you would like to just kick the tires on our service, 30-day free trial. You can't beat it. It's $0. And then you can check out all of our chart lists and everything that we do for our members. Have a great day, everybody. Enjoy your weekend and happy trading.